folks. It's Dave Burrows. I want to thank you for joining us for another Tuesday, 4 p.m. Barometer Readings webcast. I'm going to try and take things from the top down today. Lots going on, lots to talk about. It's been a busy week. It's been a busy 3 weeks. And so why don't we just jump in from the beginning and take a quick look at what's going on. S&P continues to be above this rising 200-week moving average. It's down 3.77 or 3.8% on the week as of about 15 minutes ago. Sorry, on the month. It's been a difficult few weeks since the Trump tariff announcement started coming. But frankly, there were parts of the market that were having difficulty leading into that. But certainly the uncertainty that came along with it was not very welcome in the market. If I look at the S&P chart, we're still trading above that trend line that's been in place since the beginning of the bull market in October of 22, the structural bull market. Market rallied over the last few days off the lows. It recaptured about 40% of what was given up from the top. We have not been able to get back above this point where the market broke down from. I want to highlight that the 50-day moving average has crossed down below the 200-day moving average. And that is something that we don't see all that often. And so certainly something to watch. When we look at the tariffs, they're piling up. As it stands, it looks like total tariffs could have an impact on GDP of about 2%. That's come down with some of the revisions to tariffs over the last week by about 75 basis points. And we did have a very good rally day on Wednesday last week. After we did our webcast on Tuesday, the market opened down and there was a reversal on some of the tariffs. Market rallied like crazy, had a very big up day. And so I wanted to show you, when we look at the biggest days of rally in market history going back to 1950, and really when you move out over the next 5 days and 1 month and 3 months, it tends to be pretty mixed. And that's because, frankly, the biggest rallies come during bear markets or during large size corrections. Market get extended to the downside and then get an oversold bounce. But if you look out over 5 days, on average, the market's down about 2% from the point where it bounced. A month out, you're 1.8, 2 months out, you're on average 3% higher, but it's 56% of the time, lots of big negatives. So as I said last week, when you get a bounce, eventually you need to see a follow-through day in the next 4 or 5 days, another big percentage point gain on heavy volume to show that you've tested. If we look at the weekly chart, it's a little bit more obvious. You hit that trend line and bounced, but we are stuck here below resistance. We are below the moving averages, and important just to keep that in mind. Now, on the big up day, you had up stocks versus down stocks up 34-1. That's a big day. That's a very good breadth day. But you want to see follow through, and we haven't seen that yet. We talked last week about, when a market makes a low, very often you'll rally and then you'll retest those lows in about 60% of the cases. There are the odd case where we V-bottom and turn around and you're off to the races. But frankly, given the magnitude of the change that's taken place, and, as I mentioned last week, Stanley Druckenmiller said he felt like everything that we've learned about the world since the Second World War has been turned on its head. Global allies, trading rules, lots has changed. So there's a ton of uncertainty. We're about to head into earnings season. We've got the very beginning of it. There's bound to be companies that say, based on the uncertainty, they're going to withhold guidance or reduce the visibility of their guidance. And it's very possible in going through the earnings period, you could get a retesting period. When I look at the NASDAQ 100 on that same weekly chart, we did break the trend back to 2022. And yes, we bounced, but we bounced right up underneath this breakdown point. And same thing, the moving averages are now moving lower. So there's change taking place. Now, after the last quarterly result on non-residential fixed investment, we had a contraction. I was looking at some of the data this week, and this comes out of Chief Executive Magazine. They did a bunch of CEO interviews, and CEOs who are looking at making CapEx decisions. In January, 12% thought they would decrease CapEx. In March, 29% they thought would reduce CapEx. And in the month of April, 41% of CEOs are looking at reducing new capital expenditures. When we look at the earnings progression coming into the earnings reporting period, we are seeing revisions move a little lower. Now, that's typical. Over the course of the year, on average, we get revisions lower by 7.5%. Frankly, analysts tend to be a little bit optimistic going into the year. Where we sit right now, we've had small revisions early part of the year, but we haven't had much, live data over the last couple of weeks since we got some of these nasty surprises on what you like to call Liberation Day. So now look, we don't have to be anywhere in particular in the market. We use these tools that we have to try to identify where the leadership is, where the money's getting put to work. That could be equities, it could be fixed income, it could be commodities, it could be North America, it could be global, different leadership emerges at different points in time. We're always watching for change, and I do think that there's change taking place in this market. And sometimes when there's a lack of leadership or visibility, the best and most important job is to play defense. And I think we're sort of in that camp right now. Now, as we go along, the volatility has come down a little over the last week or so. That's great. We have seen the market go through its sorting hat, treating some sectors better than others. We've seen some stocks behave better than others because, frankly, there are certain industries and companies and geographic regions maybe do a little better coming out of this. We talked last week about how when we get into a period of deteriorating breadth, we play defense, right? The stop losses that we use on individual positions are there for a reason. When breadth starts to deteriorate, we typically take some money off the table to begin with. We tighten up the stops, and we don't really put on new positions so long as that's the case. So if I take all US stocks and put them through a machine that sorts what percent are in clearly defined uptrends versus what percent of stocks are in clearly defined downtrends, the percent of stocks in uptrends has been falling through the course of this year, starting at around 50% to where we got last week to 18%. Now that's moved up about 3%. Now this all stocks universe includes the NASDAQ and the NYSE, the American Stock Exchange. And there's obviously good ones and bad ones. Even at the worst point last week, 18% of stocks in this universe maintained their upward bias. But that's a significantly reduced basket. Now we spend a lot of time when this is falling because we want to know what is it that's holding up while the market is selling off. That's a great thing to take away because we're building our farm team. But during this period, we like to hold some cash. Right? We started with 7 or 10%, and we got stopped out of a bunch more, and we build our team. So here's where we sit this week on the indicators. A couple of interesting things. First of all, very quickly, world bullish percent, or the percent of stocks and uptrends globally, started to expand again. So it was the last area to turn down and the first area to turn up. Strange, given the fact that global economies are the ones being targeted with tariffs. US stocks, if we take the broad universe, the weakest part of the market is the NASDAQ, and that's probably because it's the most crowded. NYSE actually is behaving a little bit better. But if we take the whole universe, you can see this has been falling. In Canada, it's a little bit better, but not enough to reverse up. If we look at the percent of stocks above the 50-day moving average in all three cases, they've started to move to the right, meaning a higher percentage of stocks above their 50-day. Percent of stocks with positive weekly momentum showed an improvement, and percent of stocks trading above the 150-day moving average showed some improvement. We look globally, and I think this is interesting. London tends to be a leading market. And I don't know why. It's been that case entire my career. A lot of international investors, some fairly sophisticated investors. Japan, bullish percent turned higher. If I take all of Europe as one universe, bullish percent has turned higher in Europe. Bullish percent turned higher in Asia Pacific and parts of Latin America and Australia. What is not? Well, all US, Canada, and certain individual markets, China being one of them. But the percent of stocks in uptrends globally has moved up to 32%. That was up a few percent over the course of the week. And I always care to see what is it that turns higher first and what is it that turns higher last. So if I look at, for instance, the universe of Europe, interesting. It got as low as 20%, about the same level the US got to, but already 44% of stocks back in uptrends. Well, that's resiliency. And we look at Asia, it got as low as 18%, now back at 30. So these are important factors. We talked last week about the fact that the long-term structural bull markets that have started globally got winged, but not badly damaged. And we wanted to see what would happen as things started to improve. Now, in the US, the equity risk premium, which is the earnings yield, let's say a stock trading at $10 had $1 in earnings, that'll be a 10% earnings yield. The current earnings yield, the S&P 500, is lower than on a treasury bond, lower than the yield on a treasury bond, meaning below 4%. So it's actually got a lower earnings yield than a treasury bond. And, I don't want to make a big point of it, but the last time we were here was in 2000, when the treasury bond was yielding more than stocks and was a bigger discount even. But this is something that we have to keep in mind on. Now, if earnings pick up, that's one thing. Treasury bond yield move down, that's another. But you're not getting paid much to take the risk to buy US stocks currently. Now, on the other hand, when we look globally, the Nikkei certainly pulled back, but very quickly bounced. And we're only about 2 years into this new bull market in Japan. And frankly, if we were looking at the topics, which instead of 225 super big companies is 1,700 medium and large size businesses, the topics is outperforming the Nikkei. If we look at the Euro Stoxx 50, look at this long tail on the monthly bar. It means that it traded down here and boom, right back up to the surface. I always say the leading stock or leading market should be like a cork. If you pull it down underneath the surface of the water and let it go, it should pop right back to the surface. Now, part of that may be that Europe is made up of a lot of banks. Over 30% of the Euro Stoxx 50 is banks. There's the German market. Look at that. Came right down through the moving average and right back, in fact, is now up versus the month of March. So up on the month of April. The CAC 40 in France, same thing. The Italian market, same thing. All of these markets very quickly back to the surface. And again, I just want to highlight, we're coming out of a sideways period that goes back a long way. This tends to be at the beginning of a new bull market. And frankly, the Chinese market, despite some extraordinary tariffs that have been put against Chinese imports, really have been doing a lot better. So look, a lot of markets globally in uptrends. Argentina, look at this, now up on the month. So Argentina this week reduced capital controls. I mean, that is moving more back toward the world order of fiscally and monetary responsible governments and countries. We look at the TSX. The TSX looks a lot like those global markets. Frankly, it has recovered a bunch. It's down about 9% off the highs. So 2 weeks ago or 3 weeks ago, we showed how well global markets were doing. We showed the fact that Eurozone and the UK were seeing net inflows of capital. We showed that US stocks had remarkable outperformance but in the last year had the most significant underperformance versus global stocks since 1988. We showed how valuations were cheap for global stocks versus US stocks. And we showed how both the TSX and the MSCI All World Index had turned up relative to the equally weighted S&P. And again, this just continues. So moving ahead here to the MSCI All World ex-US Index versus the equally weighted S&P, 5 months in a row outperforming. Now, we've had an interesting reversal because after 10 years of the US dollar being very, very strong, it's weak versus all global currencies. And after 10 years of US market outperforming global markets are now outperforming. And frankly, global bond markets are outperforming. And so it's not a surprise that some foreign money is starting to leave US stocks. So this is the monthly flows, and this is a real standout. Global investors are reducing their holdings of US stocks. And this is the number of investors who say in the month of April they are planning to underweight US equities. That's a spike. So these are, I think, important data points because we've had a decade of investors building this carry trade, borrowing in their local markets, buying US dollars, buying US stocks, or buying US treasuries because that's where they could get a return. Now they're getting a return in their home market. Their currency is a lot stronger. Moving on to the bond market, you know, this picture that we've been seeing in long-term bond yields is not changed. You know, the discussion that Scott Bessent has put into the public workspace is we're going to do these things and bond yields are going to come down and it's going to get cheaper for us to refinance our debt. And that's just not happening at this point. US 30-year yields are clearly an uptrend, and we'll see whether they can get them under control. But this is something to focus on because as yields move higher, bond prices move lower, and they may become less attractive to global investors. That's the long-term treasury bond breaking down below support on very heavy volume last week. We've had a little bounce over 2 days, nothing that changes anything. We're below all the long-term moving averages. Frankly, high-grade, liquid, investment-grade bonds saw their biggest outflow since March 2020. So from where I sit, it looks like capital flows are changing. We try to focus on assets where we're seeing the wind at our back, where we're getting money coming in behind us. That's how valuations get pushed higher. Now, when I look at asset classes, S&P 500 versus long-term treasuries still remains in an uptrend. It had a very quick bounce after breaking the moving average, but it's into question. You know, we talked about how inflation tends to have a second wave. If we look at all the inflationary waves since 1920. And I think that that's very possible. When we look at commodity prices are down in the month, but again, very quickly bounced back above the moving averages. So the moving averages are moving higher, and we're above all of them. Gold continued to march higher over the course of this week. Now, I've had all kinds of people say, look, this can't be sustainable. Well, frankly, that's because people have been bull markets in gold before, but there's a lot of big buyers. When we look at central bank activity, central bank buying month by month is moving higher. Now, it may not be that Canadian central bank is buying. We have no gold. It may not be that the US central banks are buying, but it doesn't need to be. When we look at investors and flows into ETFs, we're seeing flows everywhere. But look at this. In China, 29 tons of demand in the last month, and that's an increase of 21%. So yes, there's some money coming in from the US, but I can understand why China, given what's going on, might be interested in buying gold instead of treasury bonds. And that's something that we're going to have to watch. So the move higher in gold has been going on now for 427 days since we broke out. We are now about 55% above the 200-week moving average. And that seems like a lot. But when we look at previous bull markets, 160% above, 150% above, 133% above. In the bull market started in 2021, 85% above, 83% above. So at 55% above, we're advancing, but it by no means over. And we think that ultimately we'll get a number of waves higher, and this is going to go on for several years. This was a big shift when gold started to outperform the QQQ, which is technology, in the early part of 2000. That's the last structural shift positive. It went on for a decade, and we've only just seen this reversal of relative performance, gold versus QQQ. Gold is strong versus bonds, and silver has started to move higher. And again, that's probably very early days. Copper prices, after selling off very quickly over the previous 2 weeks, bounced nicely and back up above all the support levels. So we'll see what happens here. So look, again, in the relative game, I prefer commodities over bonds. And frankly, commodities are really challenging stocks. This is commodities versus the equally weighted S&P. I just want to go back to an interesting fact I came across this week. So the US dollar has broken all of the support going back to 2022. It's below the moving averages. So the balance of evidence is likely that it is moving lower. Moving averages are all turning lower, other than the long-term moving average. CAD is rallying versus US dollar. The yen is rallying versus US dollar. The euro is rallying versus US dollar. And so the question is, how far could it go? Well, going back to that gold versus QQQ chart, gold started to rally in 2000 and rallied until 2011. The US dollar started selling off in 2000 and sold off until 2011. It was a 41% decline versus the basket of world currencies. It tends to be that gold has its best rallies when the US dollar is falling. And it also tends to be that other markets do well when the US dollar is falling. So it shouldn't be a surprise that global markets have started to outperform and commodities have started to perform better. This whole period in pink was a commodities bull market. Look, we never repeat things, but things rhyme a lot, and we want to understand what can happen. So this move in higher in gold versus the NASDAQ, I think, is really important. And it helps us not to just dismiss the fact that NASDAQ is having some difficulty on a relative basis. It may not be just a short-term thing. Now, the way you get to a gold bull market is you have a lack of gold. And when gold goes through a bear market, there's not a lot of new discoveries. So the question is, where will new gold production come from? You can't just turn it on because price has been moving higher. And we think this can extend the length of that bull market. Let's move on to some sector stuff. The XLF, financial services ETF, made up of banks and insurance companies and brokers, card companies, technologies. Again, these are monthly bars. Sharp move lower, but we're back, almost back toward the highs for the month. The Eurozone, even more substantial. Again, a new bull market in Eurozone financials. This is a very bullish price pattern when you've had a big sell-off and it reverses very quickly toward the high. If we take the XLF itself and just look at it on a price chart, a daily chart, relative strength continues to rise versus the rest of the market. That's a positive. Being back above the 200-day moving average, that's a positive. Again, we talk about that cork popping back to the surface. We are still well off the highs. The XLF high was around $53. It's $47 here. So it's down sort of 9% off the highs. But that's a nice recovery and a nice maintenance of relative strength. So we look at some of our names. Our biggest holding in the firm continues to be Fairfax. No real damage, very close to a relative strength new high. Intact Financial, the other property and casualty company we own, again, performing really well, strong relative strength. And JP Morgan for the banks, again, maintaining its upward relative strength, even though it's well off the highs, but back above the 200-day moving average. Now, if you said, well, is there something better? let's compare JP Morgan to the large bank ETF. These are the relative returns of JP Morgan versus the large banks index. The fact that it's moving higher means JP Morgan continues to outperform, so continues to be a leader. Now, going back to the Eurozone financials, very quickly bounced back toward the highs. This asks a question. If European bullish percent is positive, and if the financials appear to still be a leader, maybe we should be looking at a Eurozone bank as an add to our strategy. So I think we started a new position today in Banco Santander. Breadth is expanding at a global level. It's expanding in Europe. Look at the relative strength of Santander. Now, this is a $100 billion bank. This is not a small bank. They are around the world. Got very, very nice earnings growth, got a nice dividend yield. I think this could be a position that works its way through a bunch of our accounts. Moving on to energy. Relative strength in the gas producers has continued to be strong. I think ARC is probably the strongest one in Canada, back above a rising 200-week moving average. That's positive. Expand Energy, which was the combination of Southwest Energy and Chesapeake, which the market is still getting used to that merger, well above the moving averages. Nice rising relative strength, trading better than 89% of companies in the S&P. Both of these companies will participate in the expanding role of liquefied natural gas on the world stage. And certainly Trump is very interested in expanding the US's role in supplying energy to parts of the world that don't have it. On the infrastructure side, TC Energy, or the old TransCanada pipe, again, better than 77% of stocks, trading not far off the highs, above all the moving averages, continues to act well, and Enbridge doing the same thing. So while our exposure to energy is a little lower, I think the holdings that we have continue to be strong. The dividend yields that we're receiving and the dividend growth, I think, is going to continue to be attractive. We do have a little bit less oil exposure. Going to basic materials, well, the gold producers are performing well. This is a weekly chart, and this past week, we broke out above the highs from 2020, and that happened after it broke out the highs from 2016. This opens a whole leg higher for the gold producers, and we've stayed with the high-quality cash flow producers that pay dividends, and Agnico has just been one of the best holdings over the last year. Just continues to march its way higher. In fact, we've been higher 5 days in a row, very quickly recaptured new highs. Again, going back to that concept of a cork, clearly a leading stock, trading better than 90% of the companies in the S&P, but it's not reserved just for Agnico. Alamos Gold, trading better than 92% of stocks over the last 52 weeks. Wheat and precious metals, better than 88%. All of them make new highs. Kinross bringing up the rear with the same kind of performance. So I know this is a small part of the market. It is becoming a bigger part of the market, and we're there early. And I think the fact that there just haven't been new big developments or discoveries over the last number of years, having companies that are able to grow their production and grow their cash flows is really positive, especially when you've got the price of gold moving up much more quickly than the costs. Now, in the last 2 weeks, the price of energy's come down. Oil's much lower. So actually the cost of production is coming down, and this is out of date. We're trading above $3,000 an ounce, $3,100 an ounce. So the margins in these companies are expanding. So we think the multiples can expand, but I will highlight that investors still have yet to pick up the baton and start buying the gold miner ETFs. Lots of room to move here. Moving to the industrials. Again, very quickly, look at how quickly the aerospace companies regained all the moving averages. Relative strength continued to be strong. This is encouraging because, of course, we've had a big position in Howmet Aerospace, and it continues to perform well. The Embraer position that we put on out of Brazil, they're the third manufacturer of jets behind Airbus and Boeing. You may have seen that China today announced that they would stop receiving Boeing jets into their fleets. Now, Embraer makes small regional jets, There has been a view that they might move into larger jets. I think that would be welcomed globally, but there could be a real opportunity here. And the stock's performing well, bounced right off the 200-day moving average and turned higher. Staying in the industrials, the waste stocks continue to perform well, whether you're looking at Republic Waste in the US or the one we own, Waste Connections, very quickly, moving back towards highs. And they stand out strongly against what's happening in other parts of industrials, particularly the transports, where relative strength really has collapsed. Now, obviously, if trade breaks down, the transports are going to have a hard time. If travel and leisure slows down because consumers don't have the same dollars to spend, airlines are not as attractive. So this is a group we've stayed away from. And in fact, we're short in our macro strategy. Now I'll touch on communications quickly. Communications have bounced. They are trading below as a sector, below the moving average. Relative strength has stayed positive. We really have only one position here, and it's Netflix. And Netflix has been a champ. It's better than 95% of companies in the S&P over the last 52 weeks and moving sharply back towards highs. So actually, the key leadership groups for us have performed really, really well. And nothing has been immune. Well, I suppose the golds have been immune. But the truth is, it's important to be in relative strength. It's important to be in groups that hold up better during a decline and that rally more quickly when things stabilize. Now let's compare that to technology. Technology continues to relatively underperform and has been since June. It has clearly bounced, but unable to recapture the most recent breakdown point. The moving averages, which all at one point were moving higher, have now all rolled over, including the 200-day, and are moving lower. This is a sign that something that's selling off is something that's likely to continue. When the moving averages roll over, it becomes harder for a group to get going again. So we've talked about the fact that the S&P tech sector is below the 200-day moving average for the first time in 526 days. We talked about how the Magnificent Seven stocks, and this is an ETF that holds Magnificent Seven, relatively underperforming, not showing any change. When we talk about using point and figure charts, this is the point and figure chart for that ETF. The MAGS ETF made a high at $58, pulled back, and broke the low it had made on its way up at 55. That's the first sell signal. Rallies unable to make a new high, breaks down, gives a second sell signal. And as we move forward, just a series of lower highs and lower lows. So can this reverse? We'll see. But we're evidence-based investors. This is the same as for the tech sector as a whole and the NASDAQ as a whole. We will never put on a position where it is in a clearly defined downward trend, no matter how popular the sector is, the position is. The semiconductor sector, relative performance has been weak since June. And again, a very weak bounce, low resistance, all of the major moving averages moving lower. I really think that despite the fact that people have made a lot of money in this sector, technically it's broken for now, and we're going to need to see a fair bit of repair. The other group that's under attack is consumer discretionary, 70% of the US economy. Clearly, if there's tariffs, people might have a little bit less money to spend. Relative strength continues to wane. A little bit of a bounce again below the breakdown point, below all the moving averages. We would steer clear here. The Russell 2000 Growth Index, growth stocks as a whole, again, moving averages moving lower, trading way below the 200-day moving average. Lots of repair work to do here, no pickup in relative strength. And it's getting toward oversold, but we're not there yet. So look, this is a market of haves and have-nots. I take away a couple of key clues. Transports relative to utilities. This is a sign of what people think about the economy going forward. Transports underperforming, utilities doing a little better. That's investors focusing on defensive sectors, moving away from economically sensitive sectors. Look at the sector chart. As of last week, most groups were piled up down here on the left of the distribution curve. Remember, what we're looking at here is We're stacking all of the sectors up in columns. All the ones in this column have between 0 and 14% of stocks in uptrends, being very narrow, very little that's doing well. And if a group had almost everything working well, it'd be stacked up down here, but that just doesn't exist in this current market. Now, over the course of the week, market's done some sorting and things have gotten a little bit better. So breadth for the average sector is up 5% over the course of the week. That's great. If we look at what's on the far right, precious metals, gas utilities, that's pipelines, insurance companies turned back positive, right? Progressive is on our buy list. Savings and loans, that's regional banks, aerospace. We talk about Howmet, we talk about Embriar in those group, very quickly reverse back up. Banks, builders, retail, we'll see. So there's some improvement here, and we're watching the things that are improving. But when we stack up from the beginning of the year, it's a split market. Below zero. Spiders, that's the S&P, NASDAQ 100, technology, consumer discretionary, genomics, ARKX, that's Internet of Things, and semis. On the positive side, financials. And I have to move a little closer and read this. Insurance companies, global stocks, Japanese stocks, silver, European stocks. I believe that's India, and then gold stocks at the top. So lots of dispersion. So what does it mean for the portfolios? Well, we still have a cash weight. So the dark blue is where we are now. The light blue is where we were a month ago. So thankfully, coming into this, we had a very significant cash weight. We've taken some of the cash that we raised over the course of the period and we bought short-term government bonds, 16%. So if you do the math, that's a lot of short-term deposits. Materials has grown, but frankly, it's because share prices are going higher and it's almost entirely gold and silver. Energy is about the same as where we were a month ago because the natural gas stocks have held in pretty well, and certainly the pipes have as well. That's an overweight versus the S&P, as is materials. Financials. We did cut financials in half. As the market went into free fall, we said, let's raise a little bit more cash. And so we do have less financials, but we're in and around market weight. But if we added back some Embriart, some Santander today, it probably puts us back in line with market, but it gives us some more European exposure. Corporate bonds are about the same as where they were a month ago. Industrials are about where they were a month ago. And we had a very low weight really across all of these groups at the bottom end. Most importantly, consumer discretionary and technology, even as of a month ago. If we look at the mandates, we still have substantial cash and short-term deposits. Our weight in gold and gold miners has gone up. Frankly, they're deserving and performing a great hedge in the portfolio. And while we have lots of cash, the intention is not to stay there for an extended period of time. We know, looking at history, purchasing power of a US dollar goes down over time. So this is really just a short-term deposit that we're holding. Now, I thought this was interesting. When we look at asset class total returns year by year, this year we have gold as the strongest performer, EFI, that's global stocks, inflation-protected bonds, cash, and short-term bonds. Basically, everything else is negative on the year. So our opportunity set right now is a little bit more narrow. We do know that central banks are cutting, but weak markets have meant that financial conditions are significantly tighter, frankly, tighter than they were in 2020, which is why we're not rushing to put money back to work. When we look at credit risk, credit spreads have expanded, meaning that bond investors are demanding a little bit more to take investment grade bond risk or high yield bond risk, although not as high as it was in 22, not as high as it was in 2020, and nowhere near where it was in a financial crisis. Volatility has come down a little off the high, but we still remain outside the box, and volatility options expire tomorrow. We'll see whether volatility comes down a little bit further. Look, historically speaking, April, May tend to be better months in a new presidential cycle. Seems to me like this is a self-inflicted wound. that's happened in the US. It may well be that the long run, things will get better. And that may well be the case. It may be that tariffs wind up being negotiated. It may be that there's some solution to these things, but in the near term, we continue to be a little bit cautious. US market continues to be in a structural bull market. We'll see if it can retain its footing. And frankly, if we go back and retest the lows or test close to the lows, we'll get a better idea as to what it is that is strong, where it is we should be focusing for new purchases. But there's time for that. In the meantime, our job is to play defense. So with that, let's see if we got any questions. And hopefully we have some good ones. Hold on just 1 second. Okay, so Darren asks, was it the behavior in the 10-year Treasury that made Besant convince Trump to drop the tariff rate on April the 8th? Was it the increasing yield in the 10-year that changed the approach to the tariffs? I think for sure, lots of smart people were watching what was happening in the bond market. Apparently, Jamie Dimon from JP Morgan made a late night call saying, you really need to do something, because when you move too quickly in global markets to make changes that are too big, you can break relationships. There are lots of leveraged investors in the world, a lot of them global, that own US Treasury bonds. And when the currency starts to fall on a leveraged trade, they say, get me out. So I think that certainly the Treasury market, which is the biggest, most liquid market in the world, was not behaving well. And that caused some pressure to be put on Trump. He probably wouldn't admit it, but I think that probably had an impact. An anonymous caller saying, is Barometer ever invested in First Service? And would we explore a pullback like this? Haven't taken a close look at it, but certainly can take a look. Lawrence is asking, with the US dollar falling, what ETF would you use, say, to buy Japan that would hedge against the US dollar falling? Okay. So there are hedged and there are unhedged ETFs to own Japan. If you thought that the Japanese yen was going to fall and you wanted to buy Japanese assets but not take currency risk, you could buy the DXJ. But frankly, I think the currency is going the other way. I would prefer to buy the Japanese market in Japanese yen, because the Japanese yen is appreciating. And if you make money on the currency and make money in the market, that's pretty good. So JOF is an ETF you can use to own the smaller cap topics index, or you can use the EWJ, which is the Nikkei 225. And both of those are currency unhedged, and I would suggest those to be probably more interesting. Jerry is asking, when you talk about tightening the stop losses, what exactly does that mean? In a strong market, you want to give stocks the benefit of the doubt. So let's say as a position is moving higher, we're ratcheting the stop losses up and behind. We will give them more room. When breadth starts to contract, it tells us that our risk is higher and the risk of decline is more significant. And so we give less tolerance to a pullback in a stock, and we tighten up the stops or move them closer to the current market price. If the companies are able to prove themselves out and hold up in price, that's great. If not, they come down and hit our stops. We wind up with a little bit more cash. So we're just less tolerant of risk in a sloppy market. So I hope that explains. Let's see. The global equity fund went down a lot in 10 days. Yes, global markets went down a lot in 10 days. The model for this fund is to stay pretty fully invested. We do have 20% cash in that portfolio currently, and it is bouncing very quickly as well. So we'll be doing another rebalance, I think, tomorrow in the global equity fund. We do have new money coming in pretty much daily. And so we got to put some of that money to work. And frankly, bullish percents globally are improving. So I'm very bullish on global equity returns. And I think probably we have years in front of us of outperformance versus US stocks. Lars has another question. Dave, is gold overbought at these levels? How far can it pull back without breaking trend? So I tried to, Lars, address that earlier. Historically, in bull markets, gold has become very extended and very overbought before it has a correction, once you really wind up in a bull market. And I think generally it is because when you come into a bull market, the assets underperform for a long time. There's not a lot of investors there. And so buyers want to buy the pullbacks. So we're 55% above the long-term moving average. Historically, before you get your first pullback, you could get to 80% above the long-term moving average. And remember, the long-term moving average is moving higher. So I think that there's room to move. Now, gold's been up 5 days in a row. Can it pull back for a day or go sideways for a couple of days? Of course it can. But I think right now we don't want to play around with it too much because it's a very small asset class and there's a lot of people that I think would like to have some exposure. So we love to own assets where people are deciding that something they want to own. And just a small amount of money come in can move prices a lot. So we're not trading this so much. Ted, I recently heard about HBIL offering a 7.5% yield. I have to be honest, I'm not familiar, Ted, but I'll look into it for you. I'm always cautious about things that pay a very, very high yield. It may well be that, there's more risk than you think. Sanjay's asking about the music royalty fund. Yeah, so we're going to do another webcast for the next short while on music royalties fund. Just very simply, it's a portfolio that owns catalogs of copyrights, specifically on the most popular music from the streaming era. Our music partner has been able to acquire the songwriter's copyright, so we own the IP of the song. And the IP of the song lasts for the life of the last remaining artist who's alive, plus 70 years. So it's a very long copyright. And the fund in aggregate is generating 8 to 9% cash returns in US dollars, and is probably valued 30 to 40% below the price that similar catalogs are being traded in. So there's about 3 years left in that fund, and at the end, the fund will be valued at market value. So there's good shot at capital growth along with that 8 to 9% cash yield. And the cash is seen as a return of capital. So it attracts very little tax. And of course, music has nothing to do with the stock market. So as people listen to Spotify and Apple and Google and pay their monthly dues, even if the economy gets bad, people don't stop. They don't stop going to the movies and they don't stop listening to music. So this is a really nice diversifier per portfolio. So anybody who'd like more information on that, always happy to share. We're very proud of the copyrights that we've been able to acquire in that portfolio. Larry, by the end of this year, do we run the risk of the market starting to price in an invasion of Taiwan? Look, this has been a threat and something that's, investors think about, for years. Over time, it probably becomes a little bit more probable. But I don't think I would make investment decisions based on it unless you're thinking about like Taiwan Semiconductor. Will asks, I've been holding a considerable amount of US cash with the Canadian dollar gaining strength versus US dollar. This has had a negative impact. Is there a strategy to mitigate this? Yeah, look, the Canadian dollar is only just off the carpet, like 1 or 2% versus US dollar. And the Canadian dollar doesn't tend to move in a dramatic fashion versus the US dollar. But my suggestion is likely the Canadian dollar continues to appreciate. So I would consider owning either more Canadian dollar denominated assets or globally denominated assets. What our strategy with the global fund was to own assets in euro and yen, in British pounds, Australian dollars, and Canadian dollars. because I think those currencies will continue to appreciate. Remember, as I showed earlier in the webcast, from 2001 to 2011, the US dollar fell 40% versus the basket of world currencies. And that can happen. So best time to think about that is now. And I would focus, and certainly, Will, I could have a conversation with you about that. Andrew, are you still interested in Japan, EWJ, and EFI? Yes, yes, and yes. EWJ, JOF, and specific companies within the Japanese market. Do you consider pure silver equities to be too risky? Look, we're into a precious metals bull market. It has been historically that silver lags at the beginning, and then silver has larger percentage point moves than gold. There are some good silver equities. I own a couple personally. I own some Pan American Silver. Wheaton Precious Metals gets about 40% of their revenue from silver production. Franco-Nevada gets some pretty good royalties from silver. So no, I think it has a place in the portfolio. And Michael, last question. How would you mitigate the risk of a significant increase in U.S. withholding tax, which Republicans are proposing? Well, that's certainly something that we have to think about. As we sit right now, our exposure to the U.S. stock market is pretty darn low. As investors with Barometer, if you're in our pools, the pools are considered to be a Canadian security. If we're in a separately managed account, we do own some individually held securities. So a bigger conversation, but Michael, happy to have that with you. I think there is money leaving the U.S. stock market for a bunch of reasons, and leaving U.S. assets. There are some remarkable companies in the U.S. The problem is if the balance of evidence is that global investors even leak some of their holdings back out into their local markets, why wouldn't you want to own some of the local markets? And that's the strategy that we're taking. So I think that's it. I think that's all the questions. Listen, thanks everybody for joining in. I really enjoy the prep work that I do getting ready for these every week. It's a discipline that has us ready to talk to clients at any moment with a deck of charts that are, updated. It keeps us honest because we have to put everything in front of people, and pictures tell 1,000 words. So if you got questions that I'm not answering, please reach out. If you'd like to have a private conversation instead of with everybody on, I'm happy to do that. And otherwise, we'll see you again next week. Thanks for tuning in.